So you are in your 50s, nearing your retirement, and suddenly you realize you don't really have much savings and have not been properly investing yet. Maybe you have been busy raising a family, paying off the house, or just trying to get by, and now you're wondering, is it too late for me? You look around and you see everyone else talking about their portfolios, their CPF balances, and their retirement plans, and you start to panic a little. You think, I don't even know where to begin. How much should I be putting in? What if I lose all my money? But don't worry, because in this video, I will show you how to get started from scratch, even if you have never invested a single cent before, and more importantly, how to get your retirement savings back on track. But first things first, let's get one thing clear. You are not too late. I know it doesn't feel that way. You scroll through social media and you see Gen Zs and millennials proudly showing off their investment portfolios, talking about financial freedom and retiring by 40s, and you start thinking about how much you have missed out and all those years you could have been investing, or all those compounding gains that you could have earned. And now, with so little time, the whole idea of investing can feel not just intimidating but downright terrifying. But here's the good news, you are not behind. According to OCBC's Financial Wellness Index, among Singaporeans in their 50s, only about 64% have started making retirement plans. And even by their 60s, that number only goes up to 71%. So if you are watching this and actively thinking about how to start investing, you are already ahead than many of your peers. However, I would also be lying if I say that starting in your 50s doesn't come with challenges. The learning curve can be steep and you don't have the luxury of time to recover from big mistakes like someone in their 30s might. But here's the good news. What you lack in time, you are making up for with so many other things. You likely have higher earning power now. Maybe your mortgage is almost paid off. Your kids are all grown up, so the days of heavy school fees and tuition fees are behind you. That also means you finally have your cash flow back, and that is the most important ingredient for investing. And here's something else most people forget. You still have time. With medical and technological advances, we are living longer than before. If you are 50 today, you could easily be investing for the next 30, 40, or even 50 years. That's plenty of time for your investments to grow. So no, you didn't miss the boat. If anything, you are just boarding a different one. One that is steadier and focused on building stability rather than chasing excitement. So how do you actually get started? For every Singaporean, I would say the most important place to begin is your CPF, even before you think about investing. That's because once you reach age 65, CPF Life will start providing you with a guaranteed monthly payout for life. This becomes the backbone of your retirement income, a steady stream of money that comes in no matter what happens in the stock market. And that stability is priceless, especially when you are no longer working. For most people, I would always recommend aiming to hit at least the full retirement sum. With today's figures, that will give you around $1,600 to $1,700 a month in lifetime payouts. That's because according to studies, that amount is roughly enough to cover a person's basic living expenses during retirement, things like food, transport, healthcare, and utilities. So if you are not there yet, you need to make it a priority to reach your FRS as soon as you can. Now, here's the good news. You get plenty of help to get there. For example, under the Match Retirement Savings Scheme, the government will match dollar for dollar top-ups to your CPF retirement account up to $2,000 per year, as long as you have less than the basic retirement sum, earn below $4,000 a month, and don't live in some atas property. Besides that, you can also top up to your special account or retirement account to earn up to 6% risk-free interest, while getting up to $8,000 in tax relief every year for doing so. On top of that, your loved ones can also top up to your SA or RA and enjoy another $8,000 in tax relief on their end. So it's really a win-win. They get tax savings and you get a bigger retirement payout. And here's a useful way to think about it. For every $5,000 you top up to your RA, your monthly payouts increases by around $20 to $30. It might not sound like much at first, but over the long run, it adds up. Quick pause. With Longbridge, you can now enjoy a 12% interest booster for 90 days when you sign up. Longbridge allows you to invest in the Singapore, Hong Kong, and US stock markets with $0 commission and some of the lowest fees around. You will get a sleek, user-friendly interface, free real-time market data, powerful research tools, and all the latest financial news, all in one platform. New users can earn 12% interest booster for 90 days on up to $2,000 deposited into any of the Cash Plus funds. And the more you deposit, the more you unlock up to $800 in total rewards. Sign up using my exclusive link to enjoy another $18 exclusive rewards. Now, moving on from CPF, the next question is, what should you do with the rest of your money? Before you be like, let's invest and what big let's start with the basics first. And that means finding the right places to park your cash savings. This is important because before you even think about investing, you need a strong cash buffer to cover all your short-term needs, whether it's your emergencies, vacation travel, or simply give you a peace of mind when the market gets volatile. Because the last thing you need is to be forced to sell investments at the worst possible time during a market crash. So where should you park your cash savings? For starters, you can look at high interest savings accounts from local banks. These can offer some pretty solid returns. For example, Standard Chartered bonus saver accounts currently gives up to around 5.55% per annum when you fulfill a few simple criteria like crediting your salary, spending on their credit cards, and doing some investing through them. Otherwise, if you prefer something more straightforward and fast-free, you can also check out accounts like the UOB Stash accounts, which gives you tiered interest rates just by maintaining a higher balance, or GSS Bank, which offers a clean and no conditions interest rate. Now, here's a neat trick that not many people talk about. If you're over 55 and have already met your full retirement sum, you can make a voluntary housing refund to your CPF ordinary account. And since you have already hit the FRS, you are free to withdraw any amount from your OA. This means your OA suddenly becomes your high interest savings account, where it's giving you up to 3.5% interest while letting you deposit and withdraw anytime you like. But just know that you can only refund up to the amount you previously withdraw for your property plus the accrued interest lah. So you can't just dump $10 million inside your CPF OA to farm interest gao. Beyond that, you can also explore money market funds or cash management accounts offered by brokers and global advisors. These usually invest in short-term government securities and fixed deposits and are currently yielding around 1 to 2+% per annum. But do keep in mind that these are technically investments and not bank deposits, yeah? So the returns may fluctuate and your capital isn't 100% guaranteed, though the risk is very low. And finally, for those who prefer something more stable, you can look at Singapore government bonds like T-bills or the Singapore savings bonds. Out of this, my personal favorite is the SSB, since it lets you lock in your yield for up to 10 years while still giving you the flexibility to withdraw and get back your money the following month if you need to. Now, even after you have settled your CPF and parked your cash savings, you will absolutely need to invest. And the reason for that is simple: inflation. Let's say you have already hit your full retirement sum and are receiving around 1.7k a month from CPF Life starting from the age of 65. Sounds pretty comfortable, right? But here's the thing, with inflation at just 2.5% a year, that same $1,700 will slowly lose its purchasing power. And by the time you hit 85, that $1,700 will feel more like $1,000 today. And by 95, it will shrink further to the equivalent of about $795. And here's the real kicker, it's often during those later years that your expenses go up due to healthcare costs. You might need to visit the doctor more often, pay higher insurance premiums, or get long-term care. So while your income stays flat, your expenses keep rising. That's why your cash savings and CPF payouts alone won't be enough. And I know gold is the next craze now, with tons of people queuing to buy gold. But the truth is, over the long term, gold will just move in line with inflation. That's why gold is also known as an inflation hedge. It protects your purchasing power, but it doesn't grow it. Then, what about properties or bonds? Bonds can help with stability, and property can offer rental income, but both usually deliver moderate returns that may not keep up with the rising cost of living, especially once you account for taxes, maintenance, or interest costs. So when you look across history, the only asset class that has consistently outpaced inflation and delivered the highest long-term returns has always been stocks. Whether you look at the US, Singapore, or global markets, equities have grown wealth by around 6 to 8% a year on average, even after inflation. But of course, that brings us to the big question. If you're going to invest into the stock market, how do you even begin? There are literally tens of thousands of companies out there. So how do you know what to buy, what to avoid, and how to make sure you don't end up losing sleep over it? One of the most common pieces of advice you'll hear for people in their 50s or 60s is to invest into dividend stocks. The idea sounds perfect. You buy companies that pay regular dividends, and those payouts can supplement your retirement income. You don't have to sell your holdings to fund your expenses. You just collect your dividends and you let your capital continue to grow quietly in the background. So even if a market crash, you aren't forced to sell your holdings at a loss, right? Well, not quite, because there are actually two two main problems with this approach. The first one is concentration risk. When you build a portfolio made up of only a few dividend stocks, maybe the 3 local bank stocks, a couple of Singapore REITs, and 1 or 2 blue chip stocks, you are essentially putting most of your money into a small handful of companies, often within the same sectors, and all within Singapore. So even though it looks safe, your portfolio is actually very exposed. If Singapore's economy slows down, or if interest rates change, or if the property or banking sectors get hit, your entire portfolio can suffer, and that can leave you with lower income and falling stock prices at the same time. Then the second problem is that dividends aren't free money. Every dollar a company pays out as dividends is a dollar that no longer stays in the business to fund future growth. In other words, when a dividend is paid out, the company's value and its share price usually drops by the same amount. You are not magically getting richer. You are just taking your returns in cash instead of keeping them instead. That's why for most people, especially for those who don't have the time or experience to monitor individual companies, it's usually better to invest into a broad-based ETF instead. A broad-based ETF is essentially a basket that holds hundreds or even thousands of stocks all at once. Instead of trying to pick the best company or the highest dividend payer, you are buying a slice of the entire market. That way, even if 1 or 2 or even 10 companies fail, it will barely make a dent because dozens of other better companies will take its place. Now, some people might recommend going with the S&P 500, which tracks the largest 500 companies in the US. And to be fair, it's an excellent index, simple, diversified, and historically one of the best performers over the long run. But personally, I think that even relying only on the S&P 500 can be risky. That's because its strong performance is mostly a recent phenomenon. Over the past decade, US tech giants like Apple, Microsoft, and Nvidia have driven most of the returns. But if you look further back, especially during the 2000 to 2009 lost decade, the S&P 500 actually went nowhere. And for 10 long years, US stocks delivered almost zero returns, while international markets did much better. No one knows what the future will look like, and for all I know, the US might continue to dominate, or maybe Europe or even Japan will outperform this time, just like what happened in the 1990s. And for that reason, I would prefer a global ETF instead. A global ETF spreads your investments across both developed and emerging markets, from the US to Europe to Japan and China and beyond. It ensures you're not betting your entire retirement on just one country or one sector doing well. Sure, you won't get the highest return in any single market, but that's not the point. The goal here is stability and consistency to grow your wealth steadily while reducing the risk of being overexposed to any single one economy. Now, once you have decided what to invest in, whether it's a global ETF, an S&P 500 fund, or even a mix of both, the next step is just as important: investing consistently. Because here's the truth, it doesn't matter how smart your strategy is if you only invest once and just stop. The key to building real wealth, especially when you are just starting in your 50s, is discipline. That's because over the short term, the market can be very volatile. Sometimes it can give you negative 50% loss, other times 50% return. But over a long period of time, the returns converge to an average. In this case, the all-country world index converges to around 9% average return. That's why consistency matters so much. When you invest regularly, whether it's monthly, quarterly, or even just a few times a year, you are taking advantage of something called dollar cost averaging. This means you buy more when prices are low and less when they are high. This smooths out your average cost over time and reducing the stress of trying to guess when to invest. Because the reality is, no one, not even professional fund managers with fancy charts and decades of experience, can predict when the market will rise or fall. In fact, they get it wrong all the time. But what history does show is that markets will always recover eventually, and the people who stay invested are the ones who will come out ahead. Because over time, the market isn't driven by emotion, it is driven by human progress. Every year, businesses innovate, economies grow, and people continue to spend, build, and create. Companies adapt, new technologies emerge, and productivity improves. Even when recessions hit, markets will eventually bounce back stronger because the world doesn't stop moving forward. If you look back at the past century, we have world wars, pandemics, oil crises, inflation spikes, financial meltdowns, and yet the stock market has always recovered to reach new highs. Not because it is magical, but because behind every market are real companies solving real problems, creating value, and generating profits. And as long as human beings continue to keep pushing forward, that collective progress will keep showing up in the stock markets. And that's why long-term investors will always win, not because they can predict the future, but because they understand that progress is inevitable. Now, of course, DCA isn't magical. If anything, studies show that lump sum investing often outperforms DCA because markets tend to rise over time. So putting more money in earlier usually beats spreading it out. But what DCA does is that it can help preserve capital and even outperform lump sum in down periods by avoiding putting all your money in just before a dip. And most importantly, DCA can help you manage your emotions while lowering your initial timing risk, making it easier to stay invested for the long haul. For example, even if you have started investing right before the dot-com crash or before the 2008 financial crisis, history shows that as long as you stay invested and kept contributing regularly, your portfolio today will still be worth far more than if you had kept everything in cash waiting for the right time. This is especially important in your 50s. Your investing window is shorter, so you can't afford to make emotional, short-term decisions. You want a system that runs quietly in the background, one that removes temptation, emotion, and complicity while forcing you to stay consistent. In short, it's never too late to start, whether you are in your 30s, 40s, or even 50s. What matters most isn't when you begin, but that you begin and you stick with it. You don't need to pick the next Tesla or time every market dip. You just need a solid plan, a diversified portfolio, and the discipline to keep going even when it feels uncomfortable. Because the longer you stay invested, the more time your money has to compound. So start where you are, start small if you have to, but start today and let time do the heavy lifting for you. Anyway, that's all for this video. Hope you found this useful. Like, share, and subscribe as I'll be posting new videos every week.